Very good day to all of you. Today we'll be revising India's 2 inventories. It's a comparatively very easy standard, and as you know, the objective of this video series is to give you a pilot view of the entire standard in the least time possible, and for that we have divided the various principles of this standard into various concepts. So without any further delay, let's get into the revision. So the first concept in the standard India's 2 inventories is the definition, right? So the definition of India's 2 inventory says that inventories are assets which are held for sale in the ordinary course of business, which is nothing but your finished goods, okay? Or they can be in production process for such sale. That is nothing but your work in progress, right? Or they can be materials or supplies which are going to be used in the production process or in rendering services, which is nothing but raw material. So what do I mean by this? Inventories comprises of your finished goods, your work in progress, and your raw materials. Right? So the standard says inventories are assets which are either held for sale in ordinary course of business, which is your finished goods, or they can be in production process for such sale, which is your work in progress. Or the third, it says that materials or supplies which are used in the production process or in rendering services, which is your raw material. So all of this thing, your finished goods, your WIP, and your raw material comprises of your inventories, right? Comprises of your inventory. So that's the scope of the standard. So moving on to the concept 2, which talks about the measurement of inventory. Inventories are measured in case they are finished goods or WIP, they are measured at lower of cost or NRV, whichever is lower, right? So you all know this principle. It's a very easy principle. In case it's finished goods or WIP, it is measured at lower of cost or NRV. But the thing where you need to be careful is raw materials, right? So let's look at that. In case if it's a raw material, you need to see whether the finished goods are expected to be sold at a value greater than or equal to its cost. Whether they are expected to be sold at a value greater than or equal to its cost. If that is the case, then the raw material will be measured at cost. But if the finished goods are expected to be sold at lesser value than the cost, then the raw material will be measured at lower of cost or replacement cost. Lower of your cost or replacement value. What do I mean by that? Let's say your raw material cost is, let's say, rupees 1000 and its replacement cost is 800. Now, whether it should be booked at 1000 or 800 will depend on, let's say, whether the cost of completing that particular finished goods is 2000, and if it is expected to be sold for, so the sale value is 2500, so the cost is less than your sale value, or I can put it the other way, your sale value is greater than your cost. So the raw material will be measured at cost. But if it's the other way around, your sale value, let's say, is 1800, so in that case your sale value is less than your cost. Your sale value is less than your cost, so your raw material will be measured at its replacement cost. So your raw material will be measured at its replacement cost, right? So this is the treatment when it comes to raw material. So in case it's a raw material, then you will see whether the finished goods is expected to be sold at a value greater than its cost or less than its cost. If it is going to be sold greater than its cost, then the raw material will be measured at its cost itself. But if the finished goods is expected to be sold at a value less than its cost, then your raw material will be measured at lower of your cost or your replacement value. Lower of your cost or your replacement value. Two important notes for inventory is that inventory can be either measured item by item, right? Or you can measure it group wise, right? On group basis or item by item basis, the standard gives you complete independence, right? And net realizable value and fair value are not the same. The standard says that net realizable value and fair value, both of these concepts are not the same, obviously, right? Because net realizable value is very entity specific, right? But when I talk about fair value, I talk about the market's fair value, right? So that is market specific, whereas my net realizable value is entity specific. So both the words net realizable value and fair value are not the same. They are different from each other. Your net realizable value, if I have to put it more easily, is a very narrower term. It's a very narrower term, but your market value, your fair value is very broad because it talks about the market's fair value, right? It's very broader compared to net realizable value, right? So we have completed two concepts, first being the definition of inventory, right, which gave us an understanding of the scope of the standard. And then we went to the measurement. In measurement, two things. In case it's a finished goods or WIP, it will be measured at lower of cost or NRV. But if it is raw material, then you need to see what you need to check, whether the sale price of that finished goods is going to be, sale value is greater than or equal to the cost, or the sale value is less than the cost. If your sale value is greater than or equal to the cost, then your raw material will be measured at your cost. But in case your sale value is less than the cost, then the raw material will be measured at lower of replacement value or your cost, right? So those were the two concepts. Moving on to concept number 3, cost of inventory includes. So cost of inventory, what and all will it include, right? Now we spoke about measurement, and it said that it will be measured at lower of cost or net realizable value. So now we are going to see how are you going to determine the cost of inventory. So the cost of inventory includes all the costs incurred to bring the inventory to the present condition and location, right? Whatever directly attributable costs are being incurred to bring the inventory to the present condition and location, all those costs will be included in the cost of inventory. All those costs will be included in the cost of inventory. In that, first come the cost of purchase. What do you mean by cost of purchase? First, the purchase price. I need to purchase a raw material, right? So purchase price of that particular raw material. In that, what will you adjust? In case there's any trade discount or any rebate, that will be adjusted. Transport charges, freight charges, if any is there, that will be added. Other handling charges, if it's there. Insurance on purchase. And in case any brokerage is being paid to the intending agent, if any brokerage is being paid to the intending agents, intending agents being brokerage is nothing but buying commission, right? Buying commission. And next, let's say if you're a manufacturer, see, there are two things here. You can either be a manufacturer or a trader. In case you're a trader, then you're only going to buy from somebody and sell it, right? You're only going to buy from somebody and sell it. So your cost of inventories will be very narrower. It will be very narrow. But when you compare a manufacturer, for him, first he will incur this cost, that is cost of purchase of raw material will be incurred, and then he needs to process that, right? So that conversion cost is also to be included. That conversion cost of raw material to finished goods, that cost also needs to be included. That conversion cost also needs to be included. And what and all are included in that conversion cost? First comes the direct material, then comes the direct labor, and any other directly attributable cost will be included. Any other directly attributable cost will be included, right? And obviously then we have the overheads, right? Then we have the overheads. The overheads will be fixed and variable, right? And here, important thing, in case you've already learned this in your SCMP or in your costing already, in case they are variable overheads, then it will be measured based on your actual capacity. But if they are fixed overheads, see, fixed is irrespective of your production capacity, you're going to incur that, right? So whether you do a production or you do not do a production, fixed overheads are going to be anyway incurred, right? So in case it's a fixed overhead, you will see whether which is greater, actual or normal capacity. Actual or normal capacity, whichever is greater. If actual capacity is greater, then based on actual capacity, you will allocate your fixed overhead. In case normal capacity is greater, then based on your normal capacity, you will allocate your fixed overheads, right? But variable overheads will be allocated only based on their actual capacity, only based on the actual capacity. Then comes the other cost. What are the other costs? The standard says any other directly attributable costs which are being incurred to bring the inventory to the present condition and location has to be included in the cost of inventory, right? Any other directly attributable costs which are being incurred to bring the inventory to the present condition and location, all those costs needs to be added. Next, some important points that you need to keep in your mind are what are not to be included in the cost of inventories. What are not to be included in the cost of inventories? And for that, I told one very simple thing. Keep a core concept in your mind. Any directly attributable cost incurred to bring the inventory to the present condition and location will be included in the cost of inventory. Now here, if you see the first point, storage cost will not be included. Storage cost will not be included. You have converted your raw material into finished goods. Now this finished goods has to be sold. So for that period, you have to store it somewhere, that storage cost will not be included unless it is necessary for production. Unless it is necessary for production. Example, if you are having wine or pickle, right, they need to be stored in certain conditions, right? So that particular thing, that condition that you're creating, that storage cost that you're incurring, let's say you need to refrigerate them or whatever, you need to maintain them at certain temperature. So that particular cost that you are including, that is necessary for the production, then that storage cost will be included. The standard says if that storage cost is necessary for the production, then that storage cost will be included, right? Administrative overheads that do not contribute to bring the inventory to the present condition and location. Admin overheads that do not contribute, for example, salary to the accountants, right? Salary to your accounts department, salary to the marketing department. These are your admin overheads which are not directly attributable to bringing this inventory to the present condition and location. Hence, they will not be added to the cost of inventory. Next is any abnormal losses. Any abnormal losses will not be added to the cost of inventory. Selling cost, in case there's some sales commission or warranty cost, any selling cost is there, then that selling cost will not be included. Cash discounts, this is more or less similar to what we learned in PP, right? Cash discount is nothing but an early settlement discount, so that will not be included. And interest cost will not be included except it is allowed by Ind AS 23. If it is allowed by Ind AS 23 borrowing cost, then it will be included, otherwise no. Otherwise no, right? Next is treatment of packaging material cost. Packaging material cost, packing material cost. So in case you're doing packaging, right, it can be two types of packaging. First is the primary packaging and second is the secondary packaging. So what does the standard say? The standard says that in case it's your primary packaging cost, that is, it is very much necessary to bring the inventory to the present condition and location, then that cost will be included in the cost of inventory. For example, I'm selling a juice. How can I sell a juice without having it canned, or I need to bottle it, right? So that particular bottle or can that I'm using, that is very much necessary to bring the inventory to the present condition and location. So that primary packaging cost will be included. But in case that a set of, let's say, 12 a dozen of bottles are being, or a carton of bottles are being packed in a cardboard box, so that is your secondary packaging. That is your secondary packaging, and it is not included in the cost of inventory, since it is a selling cost. Since it is a selling cost, right, it is not included in the cost of inventory. For example, as I told you, the cardboard box that you use, right? But the bottles, let's say, that you're using, or the cans that you're using, that are very much necessary to bring the inventory to the present condition and location, so that primary packaging cost will be added to the cost of inventory. But the secondary packaging cost will not be added, because in simple terms, it's your selling cost. It is your selling cost. So that's the reason we'll not be adding, right? That's the reason why we'll not be adding. And here you have already read that selling cost will not be added. Selling cost will not be included, right? Next is when inventory is acquired on a deferred settlement basis. What do you mean by deferred settlement basis? Over and above the normal credit terms, right? The sale is happening. Over and above the normal credit terms, the sale is happening. That is, some amount is being paid in excess of the normal purchase price of that particular asset, right? So the excess amount that you pay is nothing but your finance cost. The excess amount that you pay is, in simple words, your interest. It's your finance cost. In simple words, it's your interest. It's your finance cost, right? Which is your interest and a finance cost. So the extra amount which is paid over and above the normal purchase price is treated as interest expense or finance cost over the credit. So it is treated as a finance cost, and you will take it to your P&L, and it will not be added to the cost of inventories, right? It's a similar treatment as we do in PP. It's a similar treatment as we do in PP. Next point comes the allocation of joint product. In case you are producing some joint product, and then how you will allocate the cost. In case you're producing some joint product, how you will allocate the cost. If the cost of each joint product is separately identifiable, in case the standard says, in case you are able to identify the cost of each joint product separately, then the cost of such joint product will be that separately identified cost. Then it will be that separately identified cost. But in case you're not able to identify the joint cost separately, then the cost of the joint product is not separately identifiable. Then what you will do, you will take the total common cost, whatever has been incurred, and from that you will reduce the net realizable value of, if there is any scrap or any byproduct, then you will get this total joint product, correct? This joint product will be divided on this total cost, joint cost, right, will be divided for that. Let's say there are two joint products, A and B. So it will be divided between A and B in the ratio of their sales value, in the ratio of their sales value, in the ratio of their sales value. Let's say they are expected to be sold, let's say 10,000 units. A will sell 10,000 units. B will sell 20,000 units. This will sell at 20 rupees. This will sell at 40 rupees, right? So it becomes how much? Right? So 2 is to 8. You will divide it in the ratio 1 is to 4. You will divide it in the ratio 1 is to 4. Your total joint cost will be divided between A and B in the ratio of 1 is to 4. Yeah, got it? So the standard says in case you are able to separately identify the cost, then it will be separately whatever cost is being identified, you divide it accordingly. But in case you're not able to separately identify the cost, then take the total common cost that has been incurred. From that, you subtract any scrap, net realizable value of any scrap or any byproduct, and what you get, the total common cost, your joint cost. That joint cost will be divided in the ratio of the sales value of the joint products, in the ratio of the sales value of the joint product, right? Is what the standard says. Is what the standard says. So moving on to the next point, I'll come back to this. Let me complete the cost measurement technique and then we'll go back to COGS and net realizable value, right? So when you see the cost measurement techniques, they are divided broadly into two categories. In case the inventories are ordinarily interchangeable, or in case the inventories are not ordinarily interchangeable. What do you mean by not ordinarily interchangeable? For example, let's say you go to a laptop showroom, right? So they have different laptops. They have an HP, they have a Dell, they have a Mac. Okay, so you cannot interchange the laptops, right? They can be very clearly differentiated from each other, right? So in that case, they say that you will use specific identification method. In that case, what you will do, you will use the specific identification method you will be used in case you cannot interchange, in case it cannot be interchanged. For example, in jewelry or tailor-made items, you cannot interchange them, right? Because every item is unique, so you will use the specific identification method. But in case the inventories are ordinarily interchangeable, you will see whether you want to use the historical cost method, whether you want to use the historical cost method. In historical cost method, what comes? There are two. There's either FIFO or there's weighted average. There's either FIFO or there is weighted average. How do you calculate the FIFO? Units that are purchased are divided by the units first that are sold out. Which are first sold out. Units that are purchased divided by produced first are sold out. Whichever is produced first are sold out, right? Either units that are purchased or which are produced first are being sold out. But in case it's a weighted average method, how you will do? Cost of opening stock, with that you will add the cost of purchase or production during that particular period. Okay, that will be divided by the production during the period. That will be divided by the production during the period. That will be divided by the production during the period, right? Here you can see the formula. But in case it's a non-historical cost method, so when do you use a non-historical cost method? Mostly a non-historical cost method is used when the cost cannot be reliably measured. When the cost cannot be reliably measured. So when I cannot measure the cost reliably, then I go for this non-historical cost method. Non-historical cost method has two methods. The standard cost method, it is used where the normal levels of material, labor and capacity are involved. Where normal levels of material, labor and capacity are involved, fixed cost per unit is determined. What you will determine? Fixed cost per unit will be determined. Next is the retail method or the adjusted selling price method. That is, I don't know the cost. Okay, then how will I determine? So the standard says very easy. Okay, you do not know the cost, no issues, but you know the sale price, right? You know the sale price. And then you say, yeah, the sale price is 1,000. And the standard then asks, what is the expected margin for these kind of goods? What is the expected margin for these kind of finished goods? You say 15% is the margin. What do you mean by margin? Your gross profit, right? Your gross margin, you say it's 15% or you say it's 20%. So the standard says, don't do one thing. From the sale value, you reduce this gross margin. So whatever comes is your cost. So whatever comes is your cost. So this is nothing but the adjusted selling price method. So using the selling price, you're adjusting the selling price with the gross margin, and then what comes, you're considering that as to your cost. You're considering that as to your cost. You're taking a selling price, you're adjusting that for your gross margin, and whatever comes is being taken as your cost, right? So that is your non-historical cost method. So first you will see in the cost measurement technique, you will see whether the inventories are ordinarily interchangeable or they are not ordinarily interchangeable. If they are not ordinarily interchangeable, then specific identification method will be used. And if they are ordinarily interchangeable also, then you will see whether you want to go with the historical cost method or the non-historical cost method. Historical cost method has your FIFO and weighted average, and non-historical cost method, when will I use? When the cost cannot be reliably measured. When the cost cannot be reliably measured, I will use the non-historical cost method. In that, what are the two methods? The first one is the standard cost method, and the second one is the retail method or the adjusted selling price method, right? Next, what is the standard says here? An important note that the entity must use the same cost formula for all the inventories of the same nature, and it should use the same cost formula. It should use the same cost formula, right? Next comes your net realizable value. So net realizable value, let me discuss it broadly. Net realizable value for finished goods, for work in progress, and for raw material. If you see the net realizable value for finished goods, okay, that is what I've given you here, right? This that I've given you the table. This is the net realizable value for finished goods, which is the estimated selling price in the ordinary course of business, from which you will reduce the estimated cost. Okay, this is overall I've given. In case you want to calculate the net realizable value, so then you will take the estimated selling price in ordinary course of business. In case there's a cost of completion, for example, if you have a work in progress, that time your raw material is not turned into finished goods. And do you think anybody will buy that work in progress? No. So how you will calculate for that work in progress the net realizable value? You will take the selling price. You will take the selling price of the finished goods. With that, you will deduct the cost of completion. How much ever more work is to be completed, right? That cost of completion will be deducted, right? In case it is a work in progress goods. That's what I've given. This is like a combined formula I've given, right? So that is what you will deduct here. And from that, you will less the estimated cost, which is necessary to make the sale. Estimated cost that is necessary to make the sale, right? The sale commission or the trade discount you will reduce, and you will get the net realizable value. You will get the net realizable value. But in case of raw material, there is no net realizable value. Instead, there is replacement cost, which we discussed above, right? The replacement cost concept, we have already discussed that above, right? When you will use the replacement cost. Okay. So the net realizable value, overall, you will take the estimated selling price that in the ordinary course of business. From that, you will less the estimated cost of completion, and you will also reduce the estimated cost of sale, if anything is there, and then you will arrive at the net realizable value, right? And next comes the cost of goods sold, or COGS, right? What are the formula to determine the COGS? It's very easy. Opening stock, you will add the purchases, and you will less the cost of closing stock. You will arrive at the cost of goods sold. You will arrive at the cost of goods sold. Or very easier way to arrive at the cost of goods sold is, in case you have cost per unit, you multiply that with the units that are sold. You will arrive at the cost of goods sold, right? And in case of fixed overheads, we have to calculate the fixed overheads per unit on the basis of the normal production, as we have already discussed, right? In case it's fixed overhead, you will compare normal production versus actual production. Right? If normal production is greater, whichever is higher, that will be used, and according to that, you will allocate the fixed overheads. That's what I have explained here. According to that, you will allocate the fixed overheads, right? That's what I have explained here. Next comes the derecognition of inventory. How will derecognition of inventory? Once the inventory, your raw material, has turned into your finished goods, the inventory is being sold, then what entry you will pass? Will you pass bank to inventory? No, right? So what entries you will pass? First, it will be your sale entry will be there, right? Your finished goods is getting sold, so your sale entry will be there. So either cash, bank, or debtor to sale. That's what I've passed here, right? And then you will compare, and then your inventory is getting converted. Into your COGS. So for that, you will pass the entry COGS to inventory. Now, if you want to see that from this entry itself, you will arrive at your profit or loss. How? If you for that, I've given you, for better understanding, I've given you a FS extract. If you see here, sales you will be recording here through this entry, right? Through this, you will get the COGS, and the difference of these two will be either your gross profit or your gross loss, or the difference of that will be either your gross profit or your gross loss, right? So these are the two entries that are involved in case of inventory is being sold. And if your inventory is being used in the construction of your property, plant and equipment, if your inventory is being used in the construction of your property, plant and equipment, then your inventory cost will be capitalized, right, to the cost of PP, and with the useful life that will also start depreciating. You will also start depreciating that, right? So in case it is being used in the construction of PP, then your inventory cost will be added to the cost of PP, and you'll start depreciating that with the use of the inventory, use of the PP with its useful life, right? You will start depreciating that. So in case, there are two ways for your inventories to get derecognized. Either you sell them, or either you use internally in your construction of your own PP. In case you sell them, then the entry will be cash, bank, or data to sales, and then your inventory, you're converting that into your COGS, right? So COGS to inventory. And if you see in the FS extract, you'll have your sales and your COGS, and the difference between them will give you your gross profit or your gross loss, right? And in case your inventory is being used in the construction of property, plant and equipment, then the inventory cost will be capitalized to the cost of PP, will be capitalized to the cost of PP, right? So that's all about the standard. It's a relatively very easy standard, right? It's one of the initial standards that you read in this. And this notes, if you want, this concept charts, they are available in the description. You can download them. I hope these were useful for you. Thank you so much.